Welcome, eCom Logistics Nation. Thank you for joining today's episode. We're on a mission to share e-commerce logistics insights, trends, successes, and challenges from the leaders and innovators in our space.
I want to be able to help a founding team make that company successful and accomplish what they're set out to do. And I do not want to run the company. That's like a misconception. Oh, you're going to take over my company. The last thing, like I would say 99.99% of VCs want to do is take over your company. Zero interest in that. We've done that. We don't want to do that anymore. But I do want to know that you hear what I say. You don't do exactly everything that I say, right? Because that's me running the company. You hear it, incorporate it, and then we have a dialogue about it. You make your decision.
Welcome, eCom Logistics Nation. Today, we're excited to be joined by Kelly Perdew, co-founder and managing partner at Moonshots Capital. Kelly is a true entrepreneur, loves the challenge of starting and growing businesses. He's served in almost every operating capacity: founder, board member, CEO, COO, CFO, biz dev, and sales. He's raised institutional equity and debt financing, grown businesses, downsized businesses, and sold businesses for 8-figure exits. He serves on boards and in advisory roles for more companies than we have time to name. He first became popular in the public after winning season 2 of The Apprentice. He's earned a BS from West Point and a JD MBA from UCLA. Kelly, it's our pleasure to have you join us today, and welcome to the show.
Thank you both for having me.
Thank you. And I got to say, on your portfolio, beyond your TV appearances, way bigger. But I got to say, for the first time on the podcast, we have a TV personality as well. So yeah.
That's right.
All right.
And you know, Kelly, I have to come clean. My ringtone used to be the theme song for The Apprentice when the show first came out. Yes, money.
I love it.
Drove my wife crazy, but I loved it. And definitely remember your season and you winning season 2. You know, as I was doing a little bit of research, I was like hit, you know, with a bat between my eyes when I realized that was almost 20 years ago. So that was quite some time ago, and certainly still feels like it was yesterday. And
well, it feels a little longer for me. That was 2005. Yeah. So before I even started my investing career. So it's been a while. Yeah, it's been a hot minute.
Yeah, exactly. So with that experience that you had with The Apprentice, and certainly with your military experience, you know, and obviously thank you for your service. Would love to hear how, you know, your military experience and how maybe that apprentice experience, you know, influenced your professional journey over these past 20 years, and, you know, anything you'd like to share from your highlight reel with the audience.
Well, as you were listing all those things out at the beginning, I'm like, oh, that just all translates to he's old. So it's definitely been an exciting and wild ride, and ending up where I am, meeting with, asking questions of like the smartest people in the world who are trying to change the world through these companies that they're envisioning and building and helping them do that. It's not even a job. Like, it's exciting on a daily basis, getting to talk to these founders. And my business partner in Moonshots Capital, Craig Cummings, also a West Point grad, he and I both count ourselves extremely lucky, you know, to be doing this. And this is, venture capital is kind of a weird animal because you don't really know if you're good at it for about 7 to 10 years into it. Right. And you can certainly get lucky and get some false positives, but you know, you need to create quite a body of work and just really grind away at it, like a lot of jobs, before you become, you know, start to exhibit some understanding, real understanding of how it works. You know, and I don't want to say mastery, but you really start to get enough experience that you can understand and see things and make decisions that, you know, have repeatable results. From a background standpoint, I would definitely, you know, give the military a lot of credit. It's impacted me in my decision on what I want to do and even how I want to do it. So At Moonshots Capital, we invest in what we call extraordinary leadership. We believe that, technologies change, and they change faster and faster. And the older I get, it seems the faster that entire industries can be turned on their head by changes in technology. And the only thing that really survives the day and is able to go execute is the leadership team. And for us, authentically, the only place in the world where millions of dollars is spent training people in leadership per se, really in leadership, is the military. So about a third of our AUM has gone into companies that have military veterans on that founding team.
That's amazing, Kelly. And there is, you mentioned that, you don't know if you're good at this for, 7 to 10 years. And the one thing I can tell you, you're really good at it. Because if you look at just the portfolio of exits, my friend, this is some of the biggest names in the industry. Pandora, LinkedIn, Robinhood, Slack, right? And the list goes on, not to talk about all the other ones. Like Tile is one more of my favorites out there, right? Just, you have actually proven it for sure. And how does someone, figure that out? One of the things about what I see on Moonshot Capital's website is it's about, and I tend to say this, right? Bet on the jockey. And it seems like it's all about betting on the jockey, right? Like, so how do you pick between where and where not to invest?
It's that's the hard part, right? We have, for instance, for Fund 2, we invested in 16 companies, and we had a little over 5,000 plans come across the transom to review. So it's very, very difficult. So, a great proxy for us, like I said, is investing in military veterans. So we hope that if there's a military veteran that's a part of a founding team that gets to a Series A, right? Because we're earlier, right? We're like a late seed round. We hope that we would have seen them before they get to that Series A at some point. And if we haven't, then we feel like, how did they get by us? Like, where do people not understand or know that Kelly and Craig at Moonshots Capital really love to see military veterans? Now, an unintended consequence of that is that, if a military veteran sends us a deal, they think they're getting funded. But it's still all of those other criteria that, most VCs use when trying to figure out where to place their bet. The size of the market. Why is the solution that this founding team going to win the day? How is it creating defensibility or a moat? Why are they uniquely situated to take advantage of what's happening in the world, what's happening with competitors, our resources? All of those things kind of come together. And there's chemistry. It takes a long time to get to liquidity, to get to some successful type of exit, whether it's through M&A activity. It's typically 5 to 7 years after the company starts. And IPOs, in our experience, is like 10 to 12 year time frame, right? And that's always kind of changing. Sometimes it speeds up. A couple of years ago, it was really hot. Now it's not so hot, right? So it's longer time frames. So you are going to be spending crazy amounts of time with these founders, helping them. So the chemistry is really important too, right? Not only do you have to believe in the business and the company, but you have to believe in those founders because you're going to be with them for a long time.
Oh, that makes a lot of sense.
Yeah, absolutely. And, we definitely want to get into some of your investments at Moonshots Capital, specifically like in the eCom logistics space, namely cart.com. But before we go there, would really appreciate, because you just teed this up perfectly, things have really changed, right? So would love to get your perspective on, what's going on in the VC universe here in the last quarter of 2023. And, again, I know no one has a very clear crystal ball, but how do you kind of seeing that play out over the next couple of quarters?
Well, in kind of 2021, 22, I believe there were something like 2,000 new VCs born.
Oh, wow.
Right. So lots and lots and lots of people created venture capital funds, some with great experience and some without a lot of experience at what they were doing. And then that capital got deployed into a lot of startups. Plus, you don't need a VC, right? These days, there's crowdfunding, there's angels that, angel rounds can be millions of dollars, right? So there are a lot of different ways to get the resources to start your company. What I am seeing and what I believe is that it's, the percentages of companies that are going to get to a Series A are significantly reduced. It's no longer a good idea and a little traction. It's provable unit economics, real traction and growth, not only growth of numbers of customers, but inside of customers, you're growing revenue per customer. Like you're really focused on profit and profit margin. Like how are you increasing gross margin so that you can show that you really have a good handle and understanding of your business? So, even some of those are going to have trouble raising rounds of financing. So that kind of attention and focus on building a sustainable business also means, though, you may not have to do another round of financing if you did it correctly in that, leading up to the Series A. You may have the opportunity, and this is what we work on with all of our companies. And part of the reason we were able to survive the pandemic with most of our companies is that when we invest in a company at late seed, we're investing when a company's probably approaching $1 million in annual recurring revenue. So there's something there, right? Some de-risking so that there are some customers, some technology. Team's not fully baked, pricing's probably not figured out, still haven't got true go-to-market capability yet. And when we invest our $1 to $2.5 million as part of a $3 to $5 million round, call it, and I'm rounding off here, we want that round of financing to last 24 to 36 months. So if you're already at $1 million in annual recurring revenue, you'd figured out some things. And if we give you 24 to 36 months of runway with this round of financing, we expect that you're going to hit operational metrics that kind of blow it out of the water so that you can raise the round of financing. Or if it gets really tough, you can reduce your expenses and not be dependent upon outside financing to stay alive.
No, that makes sense. And I got to say, the environment's changed so much. Like if you just look at within the logistics space, because, there's the macro universe of all the startups that are out there and what they are going through. But logistics, if you look at the segment itself, it's going through this really unique challenge where a lot of founders, a lot of investors at the beginning of the pandemic and midway through the pandemic said this party is not going to stop in the e-commerce space. The capacity challenges, the transportation challenges, etc., that came into play. And I mean, Toby from Shopify actually came out and said we made a mistake. Right, like they literally came out and said we thought the party wasn't going to stop, which is on record actually them calling that out. And I think he said it maybe 7, 8, 9, 10 months ago at this point. But then you are starting to see the impact of that now cascading through the industry. I mean, Convoy, where you have investors like, there is Bill Gates actually invested in there, and there is Al Gore invested in that, right? And all of a sudden, this unicorn, multi-billion-dollar unicorn, just shuttered. They closed shop. Right. And that is starting to create this ripple effect in the industry. And we can also say this, right? Like we do some angel, again, small angel, right? And our observation is the same, right? Like some of our investments are coming back and going, guys, the market's changed so dramatically. We got to figure out a new strategy. And I think to the point you were making, right? Like to tie that thread of military, or ex-army folks, right, that have that mantle of leadership to be able to kind of hold it, pivot or persevere and actually change the business model. And that's kind of, going back to that leadership. I think that's what's going to get tested now is, are you going to shut down shop or are you actually going to persevere through these challenging times, right? Because the market's going to stabilize. That there is no question. I mean, the reports are already starting to show improvements, slight improvements, but it's going to be a matter of how long.
Yeah, I do think that the macro trends are definitely cutting both directions. Obviously, moving for significantly higher interest rates and making money cost something has impacted how freely it moves, obviously, right? And I still see and I still believe that there's, flight to quality, because the people who did raise money, the capital allocators, have to deploy that capital, right? So they're all going to kind of focus on those that have the best metrics and those that are moving well. So there'll always be winners that keep winning. And really, the people who lead those have made the best decisions, attracted the best teams, and are performing. And that's the leadership piece. And I want to be clear, while my business partner and I are both military veterans, only about a third of our investments have gone into teams that have military vets on them. Now, that's a massively high percentage compared to indexing normally. But we're looking for extraordinary leadership. And the military does not have a monopoly on that, right? There are a lot of, people's personal experiences that have, they have risen to challenges and overcome those. We love, Division I team athletes, right? Because, the idea that you're part of a team and you're going to excel and make something amazing happen. There are a lot of great examples of that in our portfolio as well. So I don't want to dissuade awesome founders from coming to us if they don't happen to be military vets.
Makes complete sense.
Kelly, I wanted to ask, you have a ton of, board experience. And as I mentioned in your intro, we can't even begin to name the companies you've either been an advisor, board for, past or present. And, many of our friends and those listening in the audience, in the logistics space are either setting up a board of directors for the first time or looking to maximize the impact of their current board. Would love to hear how you approach a board role, and what have you seen most successful. And this kind of goes back to when you're doing your due diligence and you've got these 5,000 opportunities, you roll it down to 16, and you're going to spend a ton of time together with each other. I think there's still maybe some hesitation, and people don't know how to get the most out of their board. So we just kind of love your perspective on that front.
Yeah, absolutely. I actually posted maybe a month ago, 10 rules for building your board. So this is a good quiz for me. So the number one thing, and it's going to sound a little cliche, but I call it NMA, and it's no more assholes. So you literally are, you can kill yourself and your company. I've got this you have to conduct due diligence on whatever partner you're going to be taking onto your board, because you are marrying them as well. That goes both directions, right? And there has to be, and I'm not saying you have to be buddies, right? I'm saying there has to be respect. You have to get data points on that board member from other founders in bad times. How do they act? What are they, what are they trying to accomplish? Do they have your best interest at heart, all the way up to their fiduciary responsibility to their investors, to their LPs? And that's, Craig and I are cut from the founder DNA. That's who we are. So we have a massive amount of empathy, right? We've been in the seat. That is also important. When you're trying to build a company, especially early stages, you want someone who has been in the seat. You want a former operator to be on the board. When you get much, much later stage and you're dealing with mezzanine debt and thinking about going public, there is room for professionals from finance community, from wherever it might be. But when you are young, small, trying to get revenue, you can't have somebody there sitting there okay, how are we going to cut costs this month? What is the, right. That is not going to win the day, right? You're not going to save your way to success when you're just starting a company. So really having somebody with operating experience is two. Third, I think some founders get it in their head that the board needs to be an odd number of people, and probably 5 or 7. And that's wrong at the start. You want to keep the board as small as possible for as long as possible. Trying to get 5 people to agree when the next board meeting is becomes a meeting by itself to try to make that happen. So we frequently will invest where we say, if we're leading and it's in my purview, then I would be the board member with the founder, and then we would agree on a third. So, they could propose who they want as long as we agreed and met them and thought it was good. So that would be the 3-person team. Or if it's 2 founders, me and the 2 founders. But that would be that would be through a Series A. So that could be for 1 to 3 years where it's okay, we just had a mini board meeting because you texted me or called me. That's how we want to be able to iterate and move quickly, not have. Don't get me wrong. There's discipline. There is governance that's super helpful to the founder and the company around the board meetings, but you don't want it to slow you down. You don't want it to be inefficient. So we try to keep the boards as small as they can for as long as possible.
And by the way, at least 2 of those 3, I got to say, you just broke my misconceptions right there, because I'm one of those people be like, oh, you forming a board, me, even as a founder, right? I think about, I don't know much about finance. I want to bring someone with finance background onto the board, right? And I understand you're not going to save yourself by savings, right? And the other one being the 5 to 7. I always thought I needed 5 or 7 board members, right? I imagine this table around which people sit and discuss, right? And you're absolutely right. It's better to have 1 or 2 where you're just texting and just solving problems moving forward to Series A. Really good advice.
And I'm talking, generally now, right? There are specific instances where it might make sense to have a larger board. We have a company in the DoD space, and the founder very smartly, immediately as soon as possible got a retired Air Force general and a retired Navy admiral as board members because it was super impactful, right? And they weren't going to engage and be involved in daily business operations, but they were going to be hugely impactful on strategy and thought process and how to partner and who to partner with. So there are some circumstances where it can be different on specific niches, but generally speaking, smaller is better.
You know what, because you're driving more curiosity from my perspective on this now, is then there is the board advisors, right? So you got the board members, but then there is the advisor equity, because you can achieve the same thing through offering up advisor equity, right? What would be your opinion on that, right? For industry experts that you bring in, or folks with network or connections. Yeah.
Advisors are interesting. So typically what occurs is there's somebody from industry who you think's really great. You meet them for lunch. You really like them. You say, okay, what am I going to do? Okay, I'm going to give them, there's a range, and it depends where you are in your company building and how much you have allocated, still available in your option pool and everything else. But let's say you want to give them 1/4 of a point. And it's not going to earn out like the normal employee, because they don't do that. They don't last for 4 years with a 1-year cliff. If you want them, you have to engage them. It's probably 1/24 a month for 24 months. You're giving 1/24 of that 1/4 point. And what I see a lot of founders do is, okay, I have an advisor now. I got 4 of them. They're going to cover these parts of the business or this sector, and this is what they're going to do. And then they never have a meeting with them. They never on the front end say, here are the 9 things that I expect from you with time. You do 1 hour call with me once a month. You make 1 introduction every week, whatever it is that's reasonable, so that the person who's the advisor knows, holy smokes, that's more than I'm willing to commit to for that amount of equity, or I personally can't commit to that much, and manage that so that expectations are set on the front end. And then here comes the hard part. 90% of the time, they don't manage those advisors, and or the advisors are busy with their regular day jobs, so they're not getting that value, and they keep letting that equity vest. And they don't do the hard thing and walk up and say, hey, Dan, you haven't been to the last 3 calls. You haven't made any introductions. Let's give it another week. And if it's too much work for you, totally get it, but we're going to stop vesting shares for you now. And save that and find somebody else to deploy that to, even if it's an employee or whatever it might be. But they just kind of let that drag out. Now, if you find an advisor, and a lot of the, at least in Los Angeles, a lot of the ecosystems, whether it's Techstars or Amplify, or they have advisors that are around those accelerators or incubators. And those people want to be there. They're engaged and they'll try to help. So if you can find them that are engaged and helpful, awesome. And I would much prefer my founders get an advisor on the finance question like you had earlier, Ninad, than to get a whole board slot where they're in the middle of every single decision and when there's no need for that early on.
Okay, I just got to say, this is masterclass. I'm going to go back to this podcast over and over again because I'm actually getting to learn quite a lot. I'm genuinely thankful to that.
That's awesome. Yeah, I've been learning a ton here too. Want to talk about and have a little discussion about your investment in cart.com, because that certainly is super relatable to our audience from a e-commerce, and obviously they're did a logistics 3PL acquisition. But wanted to maybe just start with what did you see in that business model or in that leadership team that got you and Moonshots Capital to a yes?
Absolutely. So we have worked closely with a venture firm called Mercury out of Houston on a couple different deals. We were co-investing on one. It didn't happen. And they said, well, we have this other company that we're, early investors in, the earliest seed round, but the seed was actually taken up mostly by the founders. They put in about 20 million of their own capital, the founders. Okay. Yeah, I'll slow pause after that because you never hear that happening.
That's founders fund. Yeah.
Yeah. And Craig and I were like, huh? And they described the business to us as, and I have a pretty long background in direct to consumer because my much better half, my wife, has built and sold 5 businesses. 4 were agencies. The last one was a consultancy, all in direct to consumer, all in measured media. So I have seen and worked with and know a lot about it. And I was like, well, let's look at that. That sounds really interesting. And Omer Tariq, the CEO, has a vision, and it comes from his co-founder Jim's experience building Arctic, the cooler company.
Yep. Yeah.
So he saw that other cooler company that I won't mention, and he said, those are really expensive. This was a while ago. He goes, how hard can it be to build a metal box
cooler
that keeps things cold, right? And it shouldn't cost this much. So he's a serial entrepreneur, he and his brother, and they built Arctic from scratch. Like, let's figure this out. And I don't know the exact numbers, but it was like they sold it for like 250 million after 36 months building from scratch. Where do we find a metal box? Who can manufacture it? But they had to go through everything. They said, what's a website look like for direct to consumer? What's SEO? What's paid advertising? I need a call center. Wait a second. I need a distribution platform. Wait a second. I need returns. Right. And so they're like, how does e-commerce as a service not exist? Like, Amazon is there. Scary word. Everybody's got mixed feelings, mostly on one side of the aisle about they're not the best partner for what you want to be doing as an entrepreneur, right? Take a big chunk, privacy, piracy issues, all the other dynamics. You got kind of old school, Demandware, Magento doesn't quite fit the bill right, and you got to have developers that know how to do it. Now, of course, you mentioned Toby earlier, Shopify, awesome solution for long tail. And at least 4 years ago, some problems when you started to hit 10 million in revenue or 20 million. Like, when you're successful in Shopify, you kind of break through it and stuff breaks. So they were looking at this space that's, to the right of Amazon and above Shopify for the successful brands. Like, how do we provide e-commerce as a service? And we were like, wow, that sounds pretty compelling. Omer himself was at blinds.com, sold it to Home Depot. He was the CFO at the time. So a financially driven, a financially savvy CEO who's a killer hustler. We met him, we met Jim, and we said, we're in. So Moonshots we invested in their Series A, and then we subsequently ran a syndicate, invested in their Series B. We invested at like 100 million valuation. And the last round that they closed earlier this year was over $1 billion valuation.
And on that front, just got to say though, Kelly, right? Like, that financial genius shows because of the last round that got raised, because in an environment where almost no one's able to access capital, you are able to access capital. So
yeah, he can
absolutely.
answer all the questions. He understands what the questions are going to be from everybody before they're asked. And that financing occurred after meltdown, after kind of Armageddon, everything imploded. So it shows that there's something there on the traction side. And he grew all of that in under 3 years. When we invested, there were about 120 people in the company. And at that financing, I think there were a little over 1,000, the most recent. And that's hard to manage. Everything from integration of the acquisitions, culture, obviously is a big issue. All in a remote environment, hybrid, everybody's everywhere, in a non-trivial business to run, right? As you guys know, from the supply chain side, right? So hats off to them. It's not over, but they're kicking butt. So
absolutely. Now, the really good success story in the industry, the success journey, I would say. It's not over until it's over, and we'll see where they end up going. There is also formidable competition in the market. And like Shopify found out, logistics is hard. So
yes, it is.
Yes.
Yeah, the hard way, right?
Yeah, they found out the hard way. Exactly. I still think they should have kept pursuing that, but that's a different conversation for another day.
So Kelly, as we kind of get towards the end here, I mean, a lot of what you write about, what you speak about, what you talk about is, centered around this universe, that we've been talking about here for the last, 30 plus minutes, which is leadership, right? And I just want to kind of, hit that maybe one last time here, because it is such a pivotal factor in a startup success. And like we were just talking about with cart.com, right? I mean, that success, the last 3 years is, there's a PhD in there, right? Post, little bit of the pandemic, post-pandemic economic situation, turmoil going on around in different parts of the world, and being able to pull the team together to achieve such great success, specifically in a remote environment or hybrid environment. You've already talked about almost, many of the questions I've asked. You're like, hey, I've got a top 10 list for this. I've got a top, 8 list for that. I'm sure you have a top 10 list for maybe leadership qualities or leadership traits that you look for. Would love just to hear your thoughts on, as a good way to wrap things up, like, what are some of those dynamic traits that you are looking for, when you're exploring founders and investment opportunities?
So this time I've got more than a list. I actually published a book. So in the aftermath of winning The Apprentice, the media kept asking me, how do you think your leadership your military background helped you win the show? Or do you think, and I got almost frustrated with having to answer, because I felt like at least the media and probably a lot of the population doesn't have a true understanding of the leadership qualities and the leadership training that you receive in the military. And I'm like, my time in the military helps me with everything in life, right? Not just winning a reality show. Like I won a game show.
Right.
Woo-hoo. That's not that big of a deal, right? But how you make decisions, how you prioritize, how you respond, how you plan ahead, all of these things are critical. So there are, 10 leadership principles. It's called Take Command. 10 leadership principles I learned in the military and put to work for Donald Trump. So that subtitle was incredibly long and exactly what the publisher required. I'll hit the top 3 that we look at when we're first meeting with founders and thinking about whether or not we want to invest. So the first one is passion. I mentioned that it's a long road with a lot of low crawling through broken glass, or valley of death, people like to say, in startups, right? That to get to an IPO, most people can't do that. But even the ones that can, it's 10 and 12 years of their life. It's gray hair, it's kids, it's a lot of challenges. In order to persist and persevere through that, you have got to have a burning passion to solve a problem. There has to be something driving you, because it's not money. Believe me, everybody sees the TechCrunch articles or the splash of an IPO and this person's a billionaire now. Well, that happened right at the very end of a very long, painful process. And that passion has to be for something other than, I just want to be a tech CEO. It's got to typically be around the problem that they're solving for, whether it's from the industry, whether it's from something that personally happened to them, whether they worked in that industry and know that this problem, this pain exists, and they're the ones to solve it. So that passion piece is absolutely critical. Planning. So we meet a lot of founders who come in with a business model, a pro forma for what they're going to do and why they're going to do it and everything else. And in about 30 seconds of asking questions, whether or not they were responsible for the model and whether they have tactical and technical knowledge and understanding of that plan. And even the respect to have a plan, because in all of the 115 companies now that we've invested in, 0 of them have gone according to plan. But if you don't have the plan and you don't understand your assumptions and have really thought through the unit economics and what you're going to be doing, it's impossible for us to evaluate you. I can't know anything about what you're doing if you haven't done that work, if you don't understand. And then when we invest and we agree that, hey, one, we're cutting your revenue in half and we're adding a bunch of costs that you haven't thought of. So now let's look at the model again, scrub down. Okay. We do that iteration a few times. Now, when we give you the money and we know it's going to last 24 to 36 months, we have a plan that you're going to operate against until it doesn't make sense, i.e. market conditions change. Your team changes. You find a new product that takes off, whatever it might be. But if we don't have that plan to operate against, you're just wandering around, literally. So planning, absolutely critical. And the third one is what we call kind of coachability. And Craig and I have had 15 operating roles between us, in addition to being investors. So we've been in the seat and we have bumped our heads. We have fallen in the hole. We have failed on lots of things. And I want to be able to help a founding team make that company successful and accomplish what they're set out to do. And I do not want to run the company. That's like a misconception. Oh, you're going to take over my company. The last thing, like I would say 99.99% of VCs want to do is take over your company. Zero interest in that. We've done that. We don't want to do that anymore. But I do want to know that you hear what I say. You don't do exactly everything that I say, right? Because that's me running the company. You hear it, incorporate it, and then we have a dialogue about it. And you make your decision. Now, probably between me and Craig, I'm more likely the one that goes, "I told you so" afterwards. But that's that's stylistic, right? That's just stylistic. But having that coachability where I know you are going to hear what I'm saying, and that I'm only saying it from a place of wanting you to succeed, and if that's there, and that's got a little bit to do with humility, thirst for knowledge, like a lot of things go into that coachability piece. But I'll say that's the third one.
I'm taking down notes, by the way.
Oh,
I know exactly now the traits that I need to follow, because you are absolutely right. And in our experiences working with founders, we see these gaps, right? Where someone comes from outside, and specifically logistics. You can't just step into logistics and be like, "I'm gonna do this." Perfect example, like you mentioned the founders of Cart.com having that background and seen the pain to be able to address it. So you can't be an outsider that's going to be like, "I'm going to solve how to pack all the items in a box problem," right? Like you really need to have worked on the warehouse floor to truly understand what that problem happens to be, to then go ahead and try and solve it, right? Like the passion side, and then the coachability. I don't know where people get this idea that you have to be, what did you call it? No more assholes. I think there is also like this idea that it's okay to be an asshole, right? Like, and if someone's giving you an advice, basically going, no, I understand this, right? Maybe there is an aspect of like having this debate, but it shouldn't be, yeah, you don't know what I know, and I'm just going to keep doing what I need to do. And I think there is that that thing that I'll tell you, I've actually turned down an opportunity that came to my door just because of the coachability aspect. It was like, bro, try to do this. And it's like, nope, I'm not. And I was like, okay, I'm done with this then.
Yeah. There's a, month-long process, maybe 2 months before we get to term, before we get closed on a deal. And in that time frame, when everybody's on their best behavior, because everybody's still selling, right? If you don't even get the coachability signals in that process, then you're in trouble. And that's something that we watch for.
Absolutely.
Great advice. Great advice, Kelly. Listen, Kelly, we can't thank you enough for joining us today. Been a masterclass in a lot of things, from the VC world to leadership to just business in general. So really, really appreciate your time, and want to give you the opportunity to share with the audience. I think we'll definitely put some show notes about your book and some of where you post some of your learnings that you share. But where could they go to follow you on social media, and maybe tell everyone where they could go to learn more about Moonshots Capital?
Yeah, absolutely. So moonshotscapital.com is our website. It has links to all our social media. I'm Perfect. At K Perdew on X. Look at that. I didn't even say the T word on X. And on LinkedIn, I'm Kelly Perdew on LinkedIn, and we publish all of these things via LinkedIn, and then on the blog on Leadership Prevails on Medium.
Amazing.
Thank you very much, Kelly.
Thank you, Kelly.
Thank you guys both.
Hi, I'm Ninad Acharya, CEO and co-founder of Fulfillment IQ, and I'm here with
Dan Call, CRO and partner at Fulfillment IQ. We're the team behind the eCom Logistics podcast. Our mission is to provide you with genuine insights from our work alongside logistics leaders to help you improve your supply chain.
In the eCom Logistics podcast, we share the knowledge and the insights we've gained from working alongside amazing brands, retailers, 3PLs, and VCs, so you can make the most out of your supply chain journey.
If you like what you're hearing, we'd truly appreciate your support with a 5-star rating on your favorite podcasting channel. Your feedback not only keeps us going, but also helps others find the podcast. If you think Fulfillment IQ can assist you, or if you have an idea related to logistics, just reach out to me on LinkedIn. I'm always up for a chat and ready to explore new possibilities together.
Stay tuned to the eCom Logistics podcast on your favorite podcast platform for fresh and practical insights into e-commerce and logistics. Until next time, let's keep making a difference in logistics together.